It's Money Monday, and we're talking about things that we may have no control over, things that will impact our money and our investments. The economy, we hear, could be heading into another recession. That's why we bring on George Wells, president and founder, Legacy of America in Auburn Hills. Economists, George, are really mixed as to what's happening and if we're in a recession or not. What's your read on that?
Well, we're not going to know for sure if we're in a recession until sometime in 2012, but the fact is we're not really seeing the growth personally with unemployment and with companies growing to what we'd like to see at this point.
What is the definition of a recession? Everybody throws that word around, but we don't really understand what it means.
Well, technically, the definition of a recession is 2 quarters in a row of negative gross domestic product growth. And so we won't know those numbers again until 2012. So it just means that things are going backwards.
All right, so 2 quarters in a row of really negative growth.
That's right.
The economy, as far as all of the statistics that we see, is not in that right now nationally. However, people watching us right there have probably had 2 quarters of negative growth in their personal lives. Maybe they make less money, maybe their investments have made less money, their home's value is down. All of that says that people are hurting out there, and the American homeowner may be, the household may be in a recession.
And that's right. And it continues to happen that the volatility in the stock market continues to go up. And so the choices that you make with your investing, if you saw it as being slightly risky or moderate risky, now it's very risky because you're seeing these much bigger swings in the values of the investments in the market.
All right, and the people who we look at right there who are tracking investments and making investment decisions for their clients have to understand that what we think on our level is a lot different from what they think right there. They're making different kinds of decisions for us. Let's take a look at some of the things that we should watch out for, the things that we do not want to do. For example, you say one of the things that hurts us is when we try to time the market. Those people are probably doing it there, but when we try to time it.
Because there's so much emotion involved in timing the market, and because of the higher levels of volatility, unless you're able to have ways of investing that capitalize on that volatility, the speculation that you've done in the past will have a much more dramatic effect, which could be negative.
And failing to understand the macro environment, that's a big term there, but real quickly, macro environment means failing to understand what?
What that really means is what's happening in the economy, and the news of what's happening in the economy has a tendency to have a much bigger effect on the value of the individual stock prices, even though the stock may have a very sound fundamentals. What's happening in the general macro economy may be driving those stock prices.
So let's take a look at your best move right now, the things that we really want to do. First of all, you say prudent asset placement. What does that mean? We just have to be careful with what we buy?
Very simply, put the right money where the right money belongs. If it's in the market and you have time 7 to 10 or 15 years, it belongs in the market. It must be in a type of investment, preferably an absolute return fund where you're able to capitalize on some of this downward movement. But if it doesn't belong in the market, trying to be able to quickly go in and quickly come out may leave yourself in a very tough position and put your livelihood at risk in the future.
All right, so there is more risk today potentially out there. We have to understand that. Consider life and age needs. Of course, if we're going to retire in 2 years, we don't want all of our money in the stock market.
Just like you wouldn't take all your money to the casino, you don't want to take it all to the stock market, especially in these very highly volatile times.
All right, and also on that board it said get a second opinion, which is always a good thing to do, but it also said try to neutralize downward fluctuations. How do you do something like that? Of course, I don't want to get caught like last week when the market was down 6%.
Well, what that means is there are products that are being developed where you're able to capitalize on that downward movement, capitalize on that volatility in the market where you're able to see a benefit or see a gain when the stock market goes down dramatically.
So when the stock market goes down, these investments actually go up.
That's what they're intended to do, and that's how they're intended to work.
And that is the backdrop for what you should be thinking with your investments with a professional.
That's right.
George Wells, thank you so much. Legacy of America, Auburn Hills. We have a link to his website and much more information on our website. As always, myfoxdetroit.com. It's on the Money Monday page. Thank you, George, for being here. Good luck with your investments. We'll see you tonight when we wrap up the whole day on Wall Street.